Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, 22nd of July. Chip stocks stage a rebound this week as investors buy the dip on several encouraging headlines for the sector, but the real test is only beginning. With Alphabet and Tesla kicking off big tech earnings today after the US closing bell, investors will be looking beyond profit growth and focusing on one question: will the AI spending boom continue? So we will talk about the latest earnings and spending updates and how they could shape capital flows across the globe. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So I started the day again by looking at these two charts, the US crude and KOSPI. The former is extended gains above the $86 per barrel level for US crude and past the $92 per barrel level for Brent crude this morning. And KOSPI index is up by more than 4.5% at the time I'm talking here, led higher by Korean chip makers. Of course, following a similar jump in VanEck Semiconductor ETF yesterday in the US session. Now, what's funny is that the chip stocks are more volatile today than oil, even with the escalating geopolitical tensions that rattle the energy supply outlook from the Middle East and Russia and bring along great uncertainties regarding a short-term resolution to these conflicts. Fuel inflation expectations around the globe encourage investors to pile up into the short end of the yield curve and push longer maturity borrowing costs higher. Whereas mood among chip makers determine the market's direction more than the broad macroeconomic series that I just cited. When the chips go well, major market indices do well as well. And since yesterday, things are looking better across chip makers on the back of a few news that might have encouraged investors to buy a dip. First, AMD said it's launching its first RAG AI system to rival NVIDIA's Blackwell and Vera Rubin platforms. A RAG system here is essentially a ready-to-use AI supercomputer. Imagine a cabinet filled with hundreds of AI chips, networking, cooling, and software that work together to train and run advanced AI models in data centers. So AMD jumped 8% after the news. Then NVIDIA, which could have sold off on AMD news because of the rising competition, also rallied 2% yesterday on news that its latest chip designs are on their way to its customers. Then finally, Intel gained more than 8% as well for announcing to cut jobs and a collaboration with Fortinet, which is a cybersecurity firm that will use Intel's Foundry services to produce its next generation security chip. Overall, the news were perceived as being positive and a good occasion for investors to buy dip across chip makers. But it is impossible to say today that the recent downside correction across the major chip makers is over. I'm guessing that the upcoming earnings and spending announcements will tilt the market toward one way or the other, so the risks remain two-sided. If the big technology continues to stand behind their spending plans and top them up, the buying could continue obviously. But if the big technology that sees today's free cash flow into the chip makers' pockets, that sees the interest rate expectations and the borrowing costs mount along with the Middle East tensions, and that has yet to show investors that the investments are bearing fruit, show signs of slowing in spending growth in the coming days and weeks, we could eventually see another wave of chip sell-off hit the shore. The good news is that we won't wait long before finding out the big technology's spending plans. Already today, after the US closing bell, Alphabet and Tesla will go to the earnings or spending confessional. Now, in numbers, Alphabet has already pledged to spend around 180 to 190 billion US dollars on capital expenditure this year. That's nearly double last year's level for the company. Then Microsoft and Amazon announced plans to spend a similar amount, around 200 billion US dollars. Meta's spending pledges between 125 to 145 billion US dollars. Tesla's around 25 billion US dollars and Apple just around 14 billion US dollars. Together, this is nearly 800 billion US dollar worth of spending from just these magnificent 7 companies. And while some investors believe that big technology's total capex could fall between 800 billion to 1 trillion US dollars this year, This is the expectation. So if that's the case, these companies are expected to spell higher spending numbers when they update their earnings report in the coming hours, days, and weeks. But the story doesn't end here with the spending plans. It's also important to see whether these big technology companies actually do walk the talk. Because the latest reports actually suggest that Tesla, which set aside a capex budget of 25 billion US dollars for this year, has spent only 2.5 billion US dollars of that budget so far this year. We're past halfway through the year. So Ladder is somehow raising questions about potential underspending from Tesla this year on AI, self-driving vehicles, and robots. I mean, in the case of Tesla, these are the only dreams that keep Tesla investors on board, given that the car segment of the company is under pressure due to Elon Musk somehow damaging political journey so far and the rising competition from the Chinese EV makers as well. That's the spending front. On the earnings front, the S&P 500 tech sector is expected to report the second highest year-over-year earnings growth rate of 63.4% thanks to that AI spending. But the Magnificent Seven is not necessarily among the top contributors to that growth, nor to the nearly 25% earnings growth expected for the S&P 500 companies together in the second quarter of this year. The Magnificent Seven's earnings growth is expected to fall around just half of it, around 31% only, and that's roughly half the pace recorded in the first quarter of this year when Magnificent Seven earnings surged around 63%. That was also the strongest growth since the second quarter of 2021, where the earnings growth was around 89%. But today, that earnings growth is slowing, and you see the problem, right? Because the earnings growth is expected to slow at a time these companies rely increasingly on debt to finance that extra AI spending. And at the same time, interest rate expectations are rising the borrowing cost for the long maturity debt as well. So it will be curious to see how Magnificent Seven will make its way out of this AI spiral. Again, any pullback in spending expectations and spending plans could have dramatic consequences for top contributors to the earnings growth among the S&P 500 companies, because in the second quarter of this year, two chip makers probably occupied the top two positions. One is Micron and the other is Nvidia. Remember yesterday I wrote damned if you spend, damned if you don't? Well, I repeat that again. Softer spending plans from big technology may eventually help big tech stocks make a comeback if earnings growth follows, obviously, but it would definitely hammer the whole supply chain that has been outperforming since the past 8 to 12 months on that spending that's coming to the market. FactSet actually says if we exclude Micron and Nvidia, the blended earnings growth rate for the S&P 500 companies for the second quarter would fall from 24.7% to 16.8% only. All of a sudden, it looks much less sexy. Zooming out, in the top 5 of the best contributors to the S&P 500's earnings growth for the second quarter, there are also the names of ExxonMobil and Chevron. So obviously, thanks to the Middle East-led rise in oil and gas prices. And we also find there the name of Broadcom, which is another chip maker that is today extending its presence in the AI business. And if we zoom further out, 90% of the companies that already reported that earnings so far, including big banks, remember, they managed to beat expectations. So all eyes are on Alphabet and Tesla earnings today after the bell. We will probably have a clearer market direction tomorrow at the wake of the first big tech numbers, and we'll be in a position to argue whether the major US indices deserve to move higher on robust earnings growth, and despite the geopolitical-led worries that include higher operating costs due to higher energy prices and higher borrowing costs due to the higher energy prices and higher inflation expectations, and also a slower growth outlook for the entire world economy. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.